In 1949, a quiet sociologist named Alfred Winslow Jones discovered something. You can take risks without taking risks. Invest in some stocks, bet against others, play both sides. The result, what we call a hedge fund. But stop right here. Because Jones's cautious academic idea transformed into something else over 75 years, America's invisible system of governance. Nobody tells you its name. You don't see it at the ballot box, but it decides the rent on your home, the salary at your job, the numbers in your retirement fund. And the most striking part, it's completely legal. So how did we get here? And more importantly, has history shown us before how this ends? Money doesn't talk. History speaks. And today we're going to discuss the hidden history of hedge funds. Every empire begins with the same question: who controls the money? In Renaissance Venice, merchant guilds. In the East India Company, private armies. In 20th century America, banks. And now in the 21st century, hedge funds. The name changes, the structure remains the same. Money creates power. Power creates systems. Systems change rules. Rules enable more money. The cycle completes itself. But history also teaches us this cycle doesn't last forever. The Venetian guilds collapsed. The East India Company was dissolved. In 2008, banks were bailed out, but controlled. Now, who's next? Jones's 1949 idea began with simplicity. Take opposing positions to protect a portfolio. Invest in rising stocks. Bet against those that will fall. Call it a hedge. This logic actually dates back centuries. Dutch merchants in the 1600s would bet on future prices of tulip bulbs. English traders in the 1700s would insure their ships in Indian waters. Risk management is capitalism's main artery. But something changed in the 1980s. With Reagan-era financial deregulation, hedge funds were no longer used for protection, but for speculation. Why? Because the incentives had changed. Banks were now bound by the rule book, but hedge funds weren't. Mutual funds had to provide public reports, but hedge funds didn't. Normal investors were bound by margin limits, but hedge funds weren't. The system had created an opening. And capital always flows through openings. George Soros's Quantum Fund bet against the Bank of England in 1992. The bet was simple. The British pound is overvalued, it will fall. Within a single week, Soros made $1 billion. The Bank of England lost billions of pounds and was forced to exit the European exchange rate mechanism. A private investor defeated a nation-state. What does this story tell us? The greatest power now is not the largest army, but the largest leverage. History rhymes here. During the Napoleonic Wars, the Rothschild family became more powerful than kingdoms by controlling bond markets. In the 1920s, J.P. Morgan saved the U.S. government with his personal credit. Now hedge funds play the same role, but much faster, much more invisible. 2 Nobel Prize-winning economists founded a hedge fund. Its name? Long-Term Capital Management, LTCM. Their claim: they could calculate risk with the power of mathematics. Their model said one thing: financial crisis is statistically impossible. In 1998, Russia defaulted on its debt. LTCM's positions unraveled. $4.6 billion evaporated overnight. And worse, the fund's collapse threatened the entire global financial system. What did the Federal Reserve do? It organized a private bailout. $3.6 billion. Because the system couldn't collapse. That's when hedge funds learned something. If you're big enough, they have to save you. This was the modern version of history's oldest power. If you lend the king too much money, he becomes your problem. In the 16th century, the Fugger family had lent so much to the Spanish king that when he went bankrupt, the Fuggers took Spain's silver mines. Money doesn't talk. History speaks. And history tells us the same game is being played, just with bonds, derivatives, and algorithms. Let's pause the narrative and clarify. There are no bad guys here, just bad incentives. John Paulson saw in 2008 that the mortgage market would collapse. He didn't warn anyone. Instead, he created a product that would profit from the collapse. He made $20 billion. Millions lost their homes. Was Paulson a bad person? Maybe. But that's not the real question. The real question is, why did the system give one person the opportunity to profit from the catastrophe of millions? The answer is simple: because the system rewarded it. Derivative markets made it possible. Regulations allowed it. And the political system didn't stop it. History teaches us this. People act according to incentives. If you don't change the system, changing the players solves nothing. In the late Roman Empire, senators were accused of corruption. But the problem wasn't the senators, it was the system. Because the empire had grown so large that it had become unmanageable, power had moved away from the center into the hands of governors and merchants in the provinces. The same thing is happening now. States can no longer fully control financial flows. The speed of capital has exceeded the speed of law. After the 2008 crisis, banks were bound with strict regulations, but not hedge funds. Because hedge funds weren't banks, they didn't accept deposits. Therefore, banking laws didn't apply to them. But they did one thing. They started doing everything banks did. Lending, providing credit, even financing governments. This private credit market reached $2 trillion in 2024. As large as Italy's entire economy. This is how the system works. Close one door, capital enters through another. History rhymes exactly like this. In the 1930s, U.S. banks were restricted, but investment banking grew. In the 1970s, the Bretton Woods system collapsed, but euro-dollar markets emerged. In 2008, banks were reined in, but hedge funds filled the void. Rules change, but the logic of capital doesn't. The flow must continue. Data empire. The new intelligence networks. Hedge funds are no longer just market players. They are data empires. They buy satellite images to track oil tankers. They use thermal sensors to measure factory output. They analyze credit card data to predict consumer behavior. Financial surveillance, completely legal, quietly immense. If traditional finance is like reading last quarter's report, hedge fund finance is like reading your mind before you act. History rhymes again. The East India Company didn't just sell spices, it had the most advanced intelligence network. The Rothschild family had Europe's fastest communication network during the Napoleonic Wars. J.P. Morgan controlled markets in the early 1900s with private telegraph lines. Information always comes before money, and whoever gets the information first always wins. Hedge funds now own significant portions of a country's housing stock, corporate debt, food supply, or energy infrastructure. And the beauty of it, they don't need to threaten. Their existence is already leverage. Try to pass rent control laws, capital flows elsewhere. Regulate derivatives too tightly. Liquidity vanishes overnight. Punish speculation, pension funds, which invest billions in hedge funds, take a hit. The system is designed to keep money moving, no matter who suffers when it stops. History saw this in Rome. Senatorial families controlled grain supply. They didn't threaten to cut off grain, But everyone knew that if they got angry, Rome would face starvation. The same in Venice. The Merchant Council owned the spices. Half of Europe depended on their ships. Now hedge funds play the same role. Invisible, indispensable, untouchable. Money doesn't talk. But structural power does, and history listens to it. Here's the most unsettling truth. Your own retirement fund is probably part of it. Teachers, nurses, city workers, their retirement savings are invested in hedge funds for higher returns. But where do those returns come from? From rising housing prices, from commodity speculation, from corporate debt restructuring. This is the hidden loop of modern finance. Public money feeding private power. Without knowing it, you're financing the system, and the system turns around and raises your rent. Venetian merchant guilds controlled trade routes until they became more powerful than kings. Then they collapsed. The East India Company ruled entire countries with a private army larger than Britain's own. Then it was dissolved. In 2008, banks nearly collapsed the system. Then they were bailed out and regulated. Now hedge funds are on the same path. Empires used to be built to conquer land. Now they're conquering liquidity. The tragedy isn't that we lost democracy to corruption. The tragedy is we traded it piece by piece in the name of efficiency. Control no longer asks for permission, and every empire built on leverage eventually learns the same lesson. You can't short the system forever. Money doesn't talk. History speaks, and history tells us this story has happened before. Only the players have changed. So who really controls America? The answer isn't in the White House, not in Congress either. In the quiet offices of Greenwich, Connecticut, in spreadsheets and risk models that determine the fate of nations before breakfast, in people you never voted for, but who vote for you. History doesn't repeat, but it rhymes. And for those who want to see this rhyme, stay tuned. Because the system grows until it becomes too complex to defend itself. And when that moment comes, history moves again. Money doesn't talk. History speaks. Old money.